Welcome to Cotality's housing market update for July 2026. Brought to you by onthehouse.com.au. Australia's housing market continued to weaken through June, with Cotality's National Home Value Index falling 0.4% over the month. This was the third consecutive month of declines and the largest monthly drop we've seen since December 2022, pushing the national index 0.7% below its March peak. Sydney was the main drag on the headline result, with values down 1.2% in June. Melbourne wasn't far behind, down 1%, and ACT values fell by 0.6%. The mid-sized capitals are still generally holding up better, but the pace of growth has slowed sharply. Adelaide was flat over the month, Brisbane was up 0.3%, and Perth values rose 0.7%. That's a clear step down from the March quarter, when Brisbane and Perth housing values were rising at a much stronger monthly pace. The June quarter now looks like an important turning point. Capital city housing values were down 1.3% over the quarter, led by Sydney, down 3.2%. Melbourne was 2.6% lower, and the ACT was 1.3% lower. So what's driving these softer conditions? Well, it's not just one factor. Affordability was already stretched before interest rates moved 75 basis points higher. Since then, serviceability and borrowing capacity have been hit, cost of living pressures are high, consumer sentiment has plummeted, and policy changes have been handed down in the federal budget that are set to dampen investor demand. We're also seeing the slowdown show up in the high-frequency indicators. Auction clearance rates across the combined capitals have been below 50% since late May, and by late June they'd moved into the low 40% range. Sales activity has also softened. Capital city home sales over the 3 months to June are estimated to be more than 16% below the same time last year and almost 15% below the 5-year average for this time of the year. At the same time, advertised supply levels across the capitals is almost 11% higher than a year ago. That doesn't reflect a surge in new listings, it's more a sign that demand has weakened and stock is taking longer to absorb. For buyers, that means more choice, less urgency, and a bit more leverage in negotiations. For sellers, the market's become more competitive, and pricing expectations need to be realistic. Regional markets are still outperforming the capitals, though the pace of growth is slowing here as well. The combined regionals index was up 0.3% in June and 1.1% higher over the quarter, with regional WA remaining the strongest broad regional market, where values were up 3.7% over the June quarter. Rental markets remain tight, with annual rental growth still accelerating. Cotality's national rental index rose 0.5% in seasonally adjusted terms in June, broadly in line with May, but taking the annual rental growth to 5.9% nationally over the financial year, adding roughly $40 a week to the median rent. The longer-term increase has been substantial. Across the capital cities, rents are up almost 42% over the past 5 years, or around $217 a week. Why are rents still climbing? Well, it's all about vacancy rates being critically low. The national vacancy rate sat at 1.6% in June, well below the decade average of 2.5% and less than half the average seen in the 5 years before the pandemic. With rents rising faster than home values, gross rental yields are gradually rising. Across the combined capitals, the gross rental yield is now averaging 3.5%, up from the recent cyclical low late last year. Despite the rise, gross rental yields would need to increase significantly before rental income comes close to offsetting the holding costs faced by a leveraged investor. New investor mortgage rates are averaging around 6.4%, and investors are also dealing with higher costs for maintenance, for insurance, and strata fees. Adelaide home values are unchanged in June, the softest monthly outcome since February 2025, demonstrating a sharp slowdown in value growth. 3 months ago, Adelaide home values are up 1.2% in the month of March. Home values are up 11.6% through the financial year, adding approximately $98,000 to the median dwelling value. Lower value tiers continue to show stronger growth conditions, with values up 1.7% through the June quarter, compared with a 1.1% quarterly lift in values across the upper quartile of the market. Alongside the softer value outcomes, advertised supply levels are tracking about 12% higher than a year ago, providing more choice and less urgency for buyers. The outlook for housing markets has weakened further through June, with a broader range of headwinds now weighing on demand. The slowdown has been building for some time, initially through stretched affordability and serviceability constraints, but higher inflation and 3 rate hikes have had a clear dampening effect on demand. More recently, deeply pessimistic consumer sentiment and proposed changes in taxation policy for property investors have added to the downside pressure. Interest rate settings remain a key source of risk, even though the chance of another rate hike is moderated. The RBA left the cash rate on hold in June at 4.35%, which provided some breathing space after earlier increases, but the case for another rate hike hasn't disappeared. With underlying inflation still above target and the labour market remaining tight, the data flow over the next few months will be important in determining whether the current pause in the cash rate can be sustained. Consumer sentiment is another important factor. Confidence has improved a little as fuel prices have come down, but remains deeply pessimistic. That's likely to keep a lid on housing activity. Low confidence tends to show up in weaker turnover as households delay high commitment decisions like buying or selling a home. The federal budget has also added downside risk for housing demand. Proposed changes to negative gearing and capital gains tax settings are expected to result in a sharp pullback in investor demand for established dwellings. That comes at a time when investors had been a major source of demand across many markets and follows a broader buildup of disincentives, including higher holding costs and tighter serviceability assessments for investors. While the policy aim is to redirect capital towards newly built supply, the near-term effect is more likely to be weaker demand overall. We can already see the shift in the high-frequency indicators like auction clearance rates, which have sunk to pandemic lows, and advertised supply, which is trending higher and a clear sign that buyers are regaining some leverage. Supply-side fundamentals are also helping to cushion the market, but they aren't carrying the same weight as they were earlier in the cycle. New housing supply remains constrained, and even where approvals and commencements have improved, it will take some time for this to flow through to completions. Population growth is still adding to underlying housing demand, and rental markets remain very tight, but these forces are increasingly being offset by affordability barriers, by tighter credit conditions, and weaker confidence. The main positive is that conditions are improving for buyers who are prepared to move against the current. Lower prices, more advertised stock, longer selling times, and softer auction results are all providing more choice and better negotiation conditions for buyers. For those with secure employment, strong deposits, and enough borrowing capacity, the market's becoming less competitive. The improvement in affordability is likely to be gradual, but the shift in negotiation power is already more apparent. Overall, the outlook has become more cautious. From here, the most likely path is a further loss of momentum and a gradual drift lower in housing values rather than a sharp national correction. Tight labour markets, low levels of new housing supply, and population growth should all help to limit the downside, but the balance of risks has clearly shifted towards weaker conditions. Investor-heavy markets, higher value segments, and areas where listings have risen above average are likely to be the most exposed. The key watch points from here are reasonably clear. Whether core inflation continues to rise, whether the RBA is forced to tighten policy again, the speed and scale of the investor response to the budget changes, and whether the lift in advertised stock becomes more entrenched through the second half of the year. There's always plenty to keep an eye on. As always, you can keep on top of all the housing market updates at the inside pages of the Cotality Australia website.